market where you get VCs that invest, but they bring in a lot of expertise also along management expertise, people they have connections a lot where you may lack. How do VCs or funding folks here actually help startups in addressing some of those key issues that you find in startups?
Your investors are your partners. And one thing that I think is so important to think about when you're taking on capital is not just sort of the financial component of it, that's obviously extremely important, but this is a long-term relationship. And these people will see the good, the bad, and the ugly. And they're there to support you through all of it. And I can say as a very happy investee of AfricInvest, they have opened doors for us in places where doors are hard to open. Bank relationships are an area where our investors have really helped us weighing in on capital raise strategies. So once again, hire a good advisor, but also take input from your investors because they're seeing this every single day. They are thinking about different structures. They are in the market talking to other investors. And if they're on your cap table, they're incentivized to further your best interests as a business. So those relationships are so important. And the other thing I would say, and something that we at OneFruit try to do, is be transparent with your investors. Back to this point of having free books. When there's bad news, share it quickly. Get it out there. Share a plan for how you're going to fix it, but don't hold that stuff back. Your investors are your partners. And you as a management team, your job is to own the business plan and to execute and to present them with solutions. But your investors can be your absolute greatest allies.
Okay. George, then to you on this one. We know, we're not naming names, but we know people that raised money and sold themselves to the market as having said, this is what I was going to do with the money. And whether people are surveying investing or not, what they were told their money was going to do is not what the startup did. And all manner of things, all manner of hiccups, all manner of lawsuits, all manner of noise in the media followed. And back to, I don't know if you're going to call that corruption or just arrogance or whatever it is. How do we, as fundraisers, make sure that when you raise money, it's the right kind of money for what you're going to do, so that you don't have to be dishonest? And then next, to anyone investing in such a vehicle, how do you safeguard yourself from people that are unscrupulous?
Yeah, thanks for that. I would say that there's a couple of points I'd like to unpack here. First, go back to the question of, what do investors bring to the table other than money? It's always smart to look for an investor who can bring more than money. Yeah. And so it's the value addition, what we call value addition. It's a niche, but it's important. And challenge your potential investors to demonstrate to you how they've added value before. So it's not enough for them to tell you, because there's an elevator pitch we all make. Ask them, give us specific examples. Ask them to give them permission to do a reference check so they can call somebody and confirm that indeed you did add value beyond bringing money. So it's important to get an investor who can add that value, help you with your banking relationships, help you hire the right people, help you with regulatory conversations, help you get into new markets, etc. Help you with the management teams, their management expertise. So that's important. Unfortunately, some venture capitalists, private equities, first-time fund managers come into the market. They paint this picture that they can do and they don't do. And they end up giving a bad name, they end up destroying businesses. Yeah. We have seen in our industry where some PE, VC go and invest and they bite off more than they can chew. So not going in with an intention to defraud, but it's beyond their scope. And you must ask yourself, how did they raise that capital? How did they get backed? Because even first-time fund managers, it's okay, but there's certain safeguards that the investor should put into place. So the same thing with startups. If you're an investor in a startup, don't just give money and go away. You're not investing in a stock exchange.
Yeah.
You know, you don't expect that the business is going to make money by magic.
Yeah.
You must keep a close eye. So I don't sympathize too much with investors who say they've invested in a business and they came and found their money was misused, unless they had an arrangement that was a silent investment. And you know, sometimes what you do to protect yourself, you follow sophisticated investors. I have somebody who I know in this town, a high net worth investor. What he does, he just watches and sees where all the private equity are investing.
Oh.
And then he follows. He follows, that's his strategy. He tries to co-invest, or he tries when they're going out and another round of financial investors are coming, he tries to follow. He makes sure there's somebody who's pushing that business, who's watching the kitty, who's driving the business.
Yeah.
And he just follows, and that's a smart investment strategy. So, how do you protect yourself? Make sure that if you're a financial investor, there is a strategic investor who's doing that job of pushing if it's a private equity investment. That's one way to protect yourself. Another way to protect yourself is, of course, legal documents, etc. But the problem with legal documents is invariably you find yourself in court. That doesn't help.
Yeah.
The smart thing is to stop before, to do the prevention rather than the cure.
Yeah. You're noting down all of this, right? And I will come to you, a comment and a question you have, I know. We've seen, and I'll start with you, Franny, and then with you, Tom. PE come into this space. It doesn't happen a whole lot anymore. You're one of the different ones you're looking to actually build. But we've seen some, fly-by-night ones that they come, invest into your business, chop it up, sell to whoever in parts, and when you look at your business that you set up and it's your baby, you don't recognize it anymore, and you can't even get the amount of money that you invested in it. It just leaves you feeling all kinds of ways. Freddie, what's your advice on how we choose our investors? Yeah.
You have to have mission alignment. So one thing we at Owner Fluker are meticulous about is every decision we do, every partner we bring on, every individual we hire is made in alignment with our mission, which is to make borders matter less. And so there might be times when someone on the management team has to go with a decision that they don't necessarily agree with, but if it furthers the mission, then they have to support the decision. And so I think as you're looking at partners, it's important to have that mission alignment from day one, or else you're going to be running in different directions the entire time.
So,
no, I would agree 100%. It's not just money you are looking for. You're looking for value addition, even if it is to enable you to venture into a market segment that the investor is good at or has experience in. Because if you take the case of Britain, the stature that we have obtained or realized, a lot of it has to do with who has invested in Britain. So if it was just money we were looking for, you can get that anywhere, but as you say, what value then does that money translate into? So I think it is very important for any business to also do a due diligence to the investors. And you're actually entitled to do that. Don't just say yes to any kind of money that comes. And also, in your shareholders' agreements, give yourself some wiggle room so that in the event that what you thought you were getting into isn't what you end up in, you have some room to remember. But the good thing is there are as many good investors with good intentions than there are bad ones. But the problem is the bad ones give us
make the news,
because I think it's fair to say that some PEs have really given
Yeah.
whatever, very bad names because they are all, and I think it's those fly-by-night fellows who are themselves probably startups.
But it's just worth mentioning, Irene, that if you get an investor who starts to strip your assets and sell them, that's not necessarily a bad thing. Because maybe you've invested in your own assets. Maybe you've bought lots of real estate, and you're not a real estate company, you're a security company. Okay. So what this private equity firm will say, where are we tying down our money? We've tied up money in these various properties, let's sell them. Let's get that liquidity and let's invest it in our core business. So sometimes stripping and selling assets is a viable strategy. If it's appropriate, but again, it must be a consensus decision and you must agree. I like something that Franny said about being open to investors. Your investors are actually your source, they're a source of resolving issues.
The large companies, when an investor puts money in, like African investors in South Africa, you will ask for a governance committee, then you'll ask for an internal auditor, and you put in those mechanisms in order to make sure that there's a proactive approach before the shit hits the fan. Whether it's talent, whether it's unit economics, real-time data, why doesn't that happen in startups? Even if it's a fractional internal risk auditor instead of a full-time, what's the reason why that doesn't happen? That's my first question. My second question is, we're out of this era of easy, cheap money. Is that the reason why we're having this conversation? Right? The whole topic of today? Because, maybe these problems were happening before anyway. It's just that today there's no tolerance for it.
And we're being forced to think, the business models, traditional business models, traditional solutions don't work. So this is the right time to have this conversation. We have superstar businesses, which were, sort of dubbed Kenya's unicorns of the coming future, near coming future. They've fallen by the wayside. We've got companies that are laying off now. I think that was number 9 in my release list. It's going to probably wind up soon. There are a few big names that have gone under. So it's just the reality we're dealing with. And we must ask ourselves, how do we do this right? We keep being called the Silicon Savannah. And there's nothing wrong with failing, but fail fast. Fail, get up and move on. So I think it's just a time for us to have a reflection. It's a time for us to have a reflection moment, actually. And again, we don't have the answers between finance. The answers are in this room, and that's why we're having this conversation.
If I were to add one thing to that, if you look historically, you see sort of these periods of massive exuberance, usually followed by some sort of massive pullback, and then you'll see sort of dominant leaders emerge. So if you think about the tech bubble, if you rewind to the 90s, you had more pet delivery services than one country needed. Then the dot-com bubble burst. But then you saw the likes of Google, Facebook, really take off. And I am a big believer that we're going to see that. And right now we're in that pullback, we're in a normalization phase. And folks that can work in this operating environment and can focus on execution, particularly in hard times, have a real advantage, and there's a massive market out there to capture. And I'm extremely optimistic about sort of what the future has to hold.
Thanks. One more point I want to add. You asked about governance. Why don't we do this with startups? We should do them, even if we do it at a lower scale. We should put in place some basic governance structures. However, and then I could be killed by my partners for saying this, governance, you can put governance and tick the box. Silicon Valley Bank had the best governance.
Yeah, true.
They had gender, tick. They had diversity, tick. They had all the committees, governance, audit, strategy, all tick, tick, tick. They went under. It's because they had governance on paper, but they didn't necessarily exercise governance in practice. Because governance isn't just about having a board.
Yeah. But why don't they do that? I mean, they're putting money in, either their own or someone else's money. Why don't they do real governance?
I think what's happening actually is people drank the Kool-Aid. Sometimes people it's a herd mentality. But then during tough times, the sober moments, you have to blow the whistle, stop, and reflect.
Yeah, I also, there's one thing I could add to that. It's a resource constraint issue. I mean, I'm sure you feel this more than most people in this room working as my understanding is an earlier stage business. There's only so many salaries you can pay. But I genuinely think that this is when you can see investor partnership in its truest and greatest form. And one thing that I, as an operator, can sometimes get frustrated with is investors that come to you in these meetings and they say, "Oh, we're so excited to add value to your business." And you would say, "Oh, how are you going to do that?" And they don't have the right answer. And this is exactly the type of situation where they could second an analyst.
Exactly.
And I think we need to see more of that.
It should be the investor's responsibility to put that internal risk analysis.
Agreed. Choose the right kind of partners, actually, but you're absolutely right.
Actually, it's not that easy. As I say, we've got a group of people, and somebody brings something to the table and he says, "This is a startup, this is worth putting money in." So we look at them, we have discussions and everything. But what happens is, at the end of the day, we're putting in $100,000 in that startup. But the thing is that you as an investor should insist on some governance, but you don't. That's the problem that we have. Is because we relied on this startup and we put up, built a startup, doing trading, etc., getting money coming in. And there is some movement going in Asia and so on. But what it is that you do not want to impose on that person or that group of the startup to start. Okay, the governance that you're talking about, the minimal governance. How do you put it? Perhaps that's something that we need to learn as investors, and say that we must insist on the governance.
Thanks so much, George. I was hearing Akshay's questions and sweating in the back. Hi everyone, I'm Mushiru Kuria. I work with a fund called Amble Ventures as a partner. I'm also a venture partner at Antler, which is a big global early stage investor, and some family office investing as well. The governance question is a great one. It's expensive, is one, right? So 100K investment. What's the cost of a really good governance team, right? Or very senior people around the table. It's something we'd love to have, but definitely there's some resource constraints. One thing I do want to speak to is active investing, right? The earlier we are, the more close we are with these founders, right, and these teams. It's really a relationship where you're almost a hire at the company, right? You're hiring yourself to deliver that return. So I can't stress that enough. And now in this season where you see currency risk becoming just a challenge for companies who haven't seen that before, right? Especially in this market in Kenya, we've had a stable currency. I don't want to get into the politics of it, but we've had a stable currency for a very long time. And so these are challenges that we can come in and help startups navigate. I wish there were services that helped our startups achieve that in a cost-hacked way. That's something I'd love to see happen. I would love to see sort of rails up to larger investors who already bring that heft when they can give us our exit and they can give the companies more maturity on that front. So actually these questions are all great. I've resonated a lot with everything that's been said from the panel. Gosh, this was my worst nightmare.
Give the mic to Frank because we're going to penalize you, Frank. Yeah, he was supposed to be one of the first here. Yeah. And look at him, he got it, but you know the topic. You know the topic. And my question when I first started was to ask the Kenyan startup space, why do so many fail? But what you managed to do, George and Franny, is I'm beginning to think that maybe it's not as dire as it looks, and maybe we get the news of the ones that fail a lot more than we get the news of those that succeed. So Frank, from your bird's eye view, you'll tell us a little bit about who you work for and the vantage point you have there, and the startup space. Is it doomed in Kenya, or shall we keep going?
Thanks. Apologies for starting late. I think, first of all, let me speak about what I see happening from the point of an advisor as a firm. So I work for a firm called EY, Amsterdam, as a partner there. And the first thing I would point out is, I think startups don't know how to ask for advice. I frankly, absolutely think that startups don't know how to ask for advice, and when they do, it's too late. So we deal with a lot of startups where you're like, well, how did you even get here?
Get to this point.
Why didn't you seek advice? So I think there is space there to intervene, particularly as early as possible, and inform or enable startups to reach out to different types of advisors depending on the needs they have. And I think, I would say, for example, for EY, when we ask some of these questions, they say, we thought you're too expensive. But actually, firms like ours have free services specifically for startups. So maybe we also have a role to inform the ecosystem that there are firms out there that are willing and able to actually support startups without necessarily discussing very serious commercial. So I think that's the first thing. How can startups seek advice? A lot of the founders are not necessarily coming from a point of the renting businesses. They know how to interact with various stakeholders, and therefore this should be normal for them. So I think that's one thing. The second thing is a point she made reference to, which is you have investors who come in saying we are not just cutting you a check, we know how to support you, we'll be very hands-on, and then they abandon the startups. We've even seen it even in the PE space, where these investors actually sometimes they don't even have the capability to add value. And then that creates a trust deficit, where then you feel, just give me money. It's nothing much beyond that.
Yeah.
So I think there is that issue as well. Of course, I don't think we have a very enabling environment for startups. Our government, in many ways, has really not walked the talk. We need to have policies and other incentives to encourage the setup space. There is some movement there, but I don't think it's fully there. The last point is, I think for Africa, we need to agree that there is a bigger role to be played by corporate VCs. Companies need to actually be, big companies that are well established, or to actually, in my view, champion some of the startup space. Safaricom, I think, has Spark or something, and there are a couple of others. Corporate VC has a big role to play in exactly. Because then we introduce what Korea was talking about, what is governance, what are some of the systems we should have in place. How do you actually confirm that the operating model that or the solution, the problem you're trying to solve is a real one?
Yeah.
And then it's easier for corporates to walk the journey with the startups.
I want to support that last point because as Britain, we've set up a beta hub where we are identifying youngsters who are passionate and have ideas, but as happens so often with youngsters, they don't have the money or the working capital to see their ideas through. And we are currently piloting a telematics exercise that is really quite promising, that would otherwise have never seen the light of day. So I think corporate VCs have a role to play.
Okay, wow. You read my question there because somebody had asked what's your plan for the startup spaces, Britain. George, I will ask you, as we get to everyone else who wants to ask a question. You borrow dollars. Your revenue is in Kenya shillings. And we've all seen what the Kenya shilling is doing. I don't even know what the question looks like. Please discuss.
You know, it's interesting. A few weeks ago, to hear the governor of the central bank saying that the shilling has depreciated, but in his estimate should depreciate to the tune of about 30%. At that time, the shilling had depreciated to 20%. So some of us were sitting and we stopped what we were doing. We asked, is this a policy statement or is this a personal statement? Because it's a scary statement. The Kenyan shilling has taken a beating. Then to hear after that another statement that the shilling has been overvalued for the last 5 years. So then you ask yourself, is this an activist government or is this a serious government? So it goes back to what Frank said about an enabling environment.
Yeah.
Government has a responsibility to put an enabling environment, not to do business. Government has no business doing business. Government should provide an enabling environment. Private sector is adequate to do business.
Yeah.
So I think one of the places where we have failed and we must take responsibility as private sector is we have allowed politicians to run with business, with this with private sector business. So we have, and I like to think about, if you think about Machiavelli and the prince, he's the ruler. Think about the market, which is supposed to be the private sector space. You think about civil society. You think about the public, the ruled. Everybody has a space. We haven't done our thing. I recall 2007, after post-election violence, private sector stood up because business realized our workers were affected. We didn't have workers. The company was falling apart and private sector was just watching. It was only then that we started these engagements between KEPSA and the government. We started engagements which, I remember the late President Kibaki used to have quarterly meetings with private sector.
Do they happen? Do they still
They
happen?
don't happen anymore. Kagame has the same model in Rwanda. He meets with his private sector. He brings his cabinet secretaries there. So private sector has a role in this, in engaging government, make sure that there is an enabling environment. And so there's some work to be done around there. So when you go back to the shilling is a policy issue. I think the government has an obligation to send the right signals. What's the clarity? What people want is predictability, clarity in policy.
Yeah.
If there is no clarity, you can't do business. Today we have, I'm told, 19 different taxes and levies in Kenya. We have dropped in the ease of doing business. Those are issues that government needs to deal with. And yes, because you speak about that doesn't mean you're anti-government, doesn't mean you're opposition. You're just speaking truth to power. And not enough of us do that.
Yeah.
Certainly not in our associations. We're getting quite frustrated and tired of our associations and leadership associations thinking their job is to follow leaders and attend parties. So we really need to, but the enabling environment will not come if we don't push it.
Yeah.
We have to, as private sector, speak truth to power. Even as DFIs, diplomatic community, we have a place to make sure that space is conducive.
Okay. Frank, then I'll ask you.
Can I make a comment before you go to Frank? I just want to recognize something Korea said about active investments. That's very important, and it speaks to something that Akshay was also saying, and Ashok too. The $100,000 you raise, the group of people at Chama, you can put money and go away and hope nothing happens. But if you're active investors, you are the ones who form that governance, you form that board, you start to put pressure on the startups. That's very critical for a startup to succeed. Something else I want to echo is there is a need for private companies, for corporate to step up in promoting the startup sector. When we are fundraising, we're able to raise money from corporates in the US, in Europe, who have buckets of money to support startups. Kenyan businesses don't do that. African businesses don't do that. A few of them. It's not a blanket, but that's something we need to start doing. So what you're doing, Tom, is commendable. What you're doing at Shock with this forum is commendable. That's what private sector needs to start doing. We need to start putting money, put money where your mouth is. If we don't start thinking about the youth, we're going to be in trouble. McKinsey's latest report, released in June this year, it talks about reimagining the continent, reimagining economic growth in this environment of, hostile environment. And they're asking the question, what happened to the lions of Africa? What happened to Africa rising? They're questioning that. They're asking, did we get it wrong? The conclusion is we didn't get it wrong, but there's something we have to think about. So we don't just talk about Africa as being, having a population, a young population, and having a population of almost 1 billion who will be consumers. It's a leap of faith that because you have a population, they'll be consumers. How do you give them products which are affordable? How do you make this population educate them adequately so they can be a skillful, they can be a skilled populace? So it's changing the narrative around that.
Yeah.
There are other things they talk about. They talk about the concept of the second city. So everybody shouldn't be rushing to Nairobi. We need to invest in the second city. You think of Mumbai and Delhi. You think of New York, San Francisco. You can see Atlanta, DC. Second cities. We must invest in second cities. So there are very many interesting thoughts that McKinsey has given there. They talk about productivity. That's the other thing. It's not just about production. It's about productivity. How do we compare with everybody else? It's about intra-Africa trade. And I know I'm taking the conversation the wrong way, but all of these are things that a good startup starts to think about when they're looking forward.
For expansion.
And it's an enabling environment conversation.
Yeah. I'm still sticking with the enabling environment conversation. And Frank, this is to you. Tax. There was a time when startups, it's not that they didn't care, but they thought they could manage. Now, whether you are an individual or a business or, it's another one of those questions. You don't even know where to start. But our government, is it enabling us in terms of taxes? Or are the taxes that they're imposing on us misplaced?
I think the short answer is no. It's no. But I think the three things to highlight. The first one is government needs to raise taxes. I think in its revenue, we agree that it is need for it to mobilize resources in that sense. I think what the issue is it doesn't feel that there was enough consultation around how these taxes should be implemented, who should share the burden of these taxes, and more importantly, transparency around the use of those taxes once they are collected. So there are a lot of the pain we are feeling is not because we know we have to pay taxes. We know we do, but the level is too high. Some of it came unexpected. There's a lot of wastage, all that stuff. I think the second bit of it, which is the tax regime is not it's not tuned to the various players in the economy. If you are on payroll, you're carrying a lot of weight. Okay? If you are a startup, probably we should be saying, let's give you a tax holiday as long as you meet 1, 2, 3 things. And then when you have this capacity, we'll have a different. So something that is more customized or tailored to that. Now, our government doesn't seem to necessarily be following that approach. And even when, frankly speaking, when we've had conversations either through other business forums, let's say KEM, KEPS and all that, they listen, but they don't seem to take all those the points that were agreed. So they become talking shop. So you have a trust deficit between the taxman, the government, and yourself. I think what sticking to the startup space as far as tax is concerned, I do think that if we are going to say we are having an enabling environment, that will be just one of those pillars where we sit and say, how do we come up with a tax framework that is encouraging and supporting startups. That hasn't happened. And even when it's been raised, the implementation has not been exactly. I also think that there is a misunderstanding. I'm saying this with due respect, there are GOK people here, but I think GOK does not seem to fully understand startups versus SMEs.
Yes.
Yeah? So the policies and the responses they give are not startup friendly at all. They might be SME friendly a bit, although not all the time. So you don't, there is an education. Let me not say education. There is a gap we need to close with our government on these two entities. Startups.
The nuances and the difference.
Yes, and what they put in place is actually fit for purpose. Yes, exactly. And then the last thing I think to mention is we also have a role to play to help differentiate, to really run startups as startups and SMEs as SMEs. So that then we also don't feel our counterpart on the public sector side doesn't feel like maybe startups are being favored versus SMEs, and actually we are an SME as an example. And I do think there are governments out there that have got it right, and they've been quite clear. A startup is a startup, and once you get to a certain profile, you are an SME, and you stop being a startup, and you don't therefore enjoy the benefits of the policies that were startup friendly.
Hi guys, my name is Amir Partner. I've been on the board and part of CAN also. So I do agree with him that there should be a priority in certain times, and there was a healthy discussion happening with the government, with the cabinet secretaries, the PS, which were the heart of the whole system, which has stopped. And being an enabling environment, I think so it's a moral responsibility for all the people doing business to pay their taxes, so that the government doesn't tax us more, because they know some taxes are being avoided or ignored, or you can name names it is. So I think so once we start doing it, and then we can have the enabling environment. The government should also, what Frank has said, and Anna, the government should ensure that a business industry which comes to a certain, at the infancy, it should not be taxed at the same level. It should grow to a medium level, as we say, when I mentor people, not when they're crawling, when they're teen or they've gone over 21, then we can tax it. That's what we have seen in developing economy in Asia, in Africa, in Europe, and East European states. Like we had a digital service tax 3% suddenly because they want to capture it now. So the economy is not great. People start looking other way around. The other thing, what Frank is saying is also from January 2024, everybody are required to have a e-TIMS ledger. So the pastoralists, the cottage industries, they will definitely go down the drain because they cannot manage it. And coming back to what we've been raising issues, governance, sustainability, and economic survival. Thank you.
Thank you. One question, two questions. Okay.
Good evening. My name is Sean. I wanted to find out if anybody shared my view. I believe there's a great wall of China between our savings in Kenya, so insurances and pension money. Everything to be coming quite easily to entrepreneurs who actually need that fund. Most of that is going to government. I think in some instances, about 70% of your fund is going to government. So I don't know if anybody shares that view that maybe what needs to be done to get that money to entrepreneurs.